Late Friday afternoon, CNBC's regularly scheduled options action was superseded by Elon's action, specifically his efforts to back out of the deal to acquire Twitter. Carter and I will try to cover some of the topics we originally intended to discuss last week tonight on Open Interest. Hello, everybody, and welcome, Carter. I just wanted to quickly discuss Twitter, which has been beaten absolutely to death, and you probably don't need to hear either my opinions or maybe even Carter's on what is going on in Elon's head. But there was an important takeaway that occurred to me for anybody who trades options when you have a circumstance like that we had on Friday. Breaking news comes out after the close on a Friday. And you have options that are expiring. It's important to know that if it is before 5:30 Eastern Time, you do have the ability to contact your broker and file what's called a contrary exercise advice. And this is a circumstance when you advise your broker that options that would normally be exercised automatically, that you don't want that to happen, or options that would not normally be exercised automatically, where you do want it to happen. And why would that take place? Twitter closed at 36.91 on Friday. So that would mean that the 36.5 puts, the 36s, 35.5s, and so on, were all out of the money and would not have been exercised. It also means that the 36.5 calls, the 36 calls, the 35.5s, all would have been in the money relative to the closing price and would have been exercised automatically. After that news came out, the stock fell by $3. And if you were long those 36 calls, you wouldn't want to purchase the stock at $36 when it was trading after hours at $33 and change. And similarly, the 36.5 puts, had you owned them, you would have wanted to exercise them when the stock was trading much lower than the strike price. So I encourage everybody to familiarize yourself with your broker's rules about how you would file a contrary exercise advice if you have options that otherwise would be exercised automatically that you do not want to have, or options that were not going to be exercised, which you do want to. Okay, so with that, I'm hoping to actually touch on the things that we had planned to talk about on Friday. And Carter, you were taking a look at financials.
That's right. So, I mean, only because, well, you can look at anything at any time, but earnings season kicks off this week of the Russell 3000, the broadest aggregate we have. 43 stocks report, and 17 of them are financials, and it's big ones. It's Morgan Stanley, it's Wells Fargo, it's Citibank, it's JP Morgan, PNC, and so forth. And the intention was to just single out, call out, point out that financials, they're just not working. And so let's look at this two-panel chart. What this is a two-year chart, and it's showing XLF on the top, simply that, the ETF that measures precisely the performance of the S&P 500 financial sector. And on the bottom is relative performance to the market itself. And the arrows tell the story. We know that the S&P bottomed on the 15th of June, and so too did the financial sector. But the bounce in the financial sector has delivered no alpha. You can see on the bottom, in fact, that the relative strength, the relative performance to the market is actually making new lows. Now let's look at this same setup longer term. I mean, this is very telling. On the top, you see the plunge in 2020. That, of course, is the COVID sell-off, and the recovery to new highs and all-time highs, but not the case with relative. And so there are people who make the case, who cares about relative? If I made money, I made money. Yes and no. Obviously, a profit is a profit, but it's opportunity cost. It's other things that could have been done. So let's take a great year. If 1999, the boom year and the dot-com era, and one produced in their portfolio a return of 12% and everyone else in the neighborhood had 30, the 12's no good. It's actually quite bad. And so the problem with financials is they're not working. And I don't see what is going to make them work. The interest rate environment is not in their favor. They are not the same businesses. And Mike, you can speak to this in terms of the ability to earn. Their ROEs will never be what they were. They're much more capped and regulated, if you will. And also, they're big spenders now on technology. Nothing to do with charts, but they have to keep up. and you just don't have the margins. The final chart is the XLF itself. And to be fair, the breakout, and we looked at that right on the other chart, which didn't have concomitant relative performance, is now back to a level of support. But my hunch is we sink into support and go a bit lower here.
Yeah, this is an interesting one. So first of all, we own several financials in our fund. In the interest of full disclosure, I should state that. Our fund is long equity only, so you're not going to see us shorting financials within that as a group. And of course, this is an important week for financials. We've got a lot of the big ones are going to be reporting this week and next. I like to use JP Morgan as an example, I think, of some of the things that Carter is talking about. This is remarkable because I think it's basically, the hero amongst financials when people are thinking about the U.S. banks. And this is a company which essentially has gone nowhere for the better part of the last several years. This is pretty remarkable that you could actually purchase JP Morgan right now at a valuation that is the same that you could get several years ago. And there's very few major American companies where you could make that same statement. Now, of course, there are some good things on the fundamental side that we can talk about. For one thing, we've seen bank revenues are up 20% over that time. EPS, at least on a trailing basis, is up about 100% over that same period of time. Speaking to their earnings power, I think what is also interesting is that their balance sheet has also grown by about 50% over that time. And of course, when we're dealing with the too big to fail financials, number one, there are a lot of businesses that they are now, from a regulatory point of view, excluded from being in. And so, of course, that hurts their earnings power. And of course, the amount of capital that they need to have, which means essentially with the same amount of capital, how much can you lever that capital? Those things have also been, I'm not going to call it impaired because in a financial context, that's obviously a bit problematic, but it does get a little bit harder. But really the biggest issue, I think, to me, is that we're actually staring at some pretty ominous signs in the rate market. And that's exactly what you're talking about. 2s, 5s, inverted. 2s, 10s are inverted. The case has been made that you should buy financials because people anticipated a steepening yield curve. And what has happened? Exactly the opposite. It's inverted. So I think for a lot of people who may hold these stocks, and maybe you're not thinking about selling them, one of the things you could do is go into XLF and buy a put spread. I was looking specifically at the September 32.28 put spread. Now, on Friday, this thing was trading for just a little bit over 90 cents. I think the target when we're looking at a $4 put spread, we're looking to spend 25% or less of the distance between the strikes. In that case, this is about $1. It was trading pretty close to that. But this is a way that you could express the technical view that Carter was just outlining, or if you have a financial in your portfolio, or even several, as we do, this is an interesting and relatively low-cost way to protect the downside, and you get protection through the third Friday in September. So Carter, you were also taking a look at a stock that actually has done okay recently. I mean, not anywhere near its all-time highs, and was sort of a darling of the pandemic, Domino's Pizza. What do you see there?
Yeah, so to my eye, this is what I would characterize as a rally to a difficult level. It's impressive. It's up almost 30% off its May low. For that first chart, there are no drawings, no judgments, no annotations, no conclusions. Let's add some lines and arrows. So moving averages are important. It's a way to measure trend. Turns in moving averages are also important. And this rally leaves us to the penny back up against the declining 150-day moving average. Now, if we got rid of the moving average and use a trend line, it's the exact same level. So when you break trend in principle and then throw back all the way to the underside of the trend, you more often than not hit your head at that level. So if we combine the two charts, we have two pretty key reference points. We have our downward sloping 150-day moving average, and we have the uptrend line in effect since the 2019 low, below which the stock broke and now has rallied back to. To my eye, a rally to a difficult level. I'm a seller.
So, we often talk about something called a call spread risk reversal on the show. And I know this is appealing to a lot of folks who are first starting out in options. And the reason for that is that when you trade a call spread risk reversal, you get near upside participation from the call strike that you own up until the higher call strike that you sell, and you don't have any immediate risk to the downside until you get to that lower put strike. And one of the things I wanted to talk about today is the fact that if you happen to own Domino's Pizza and you've seen it rally like this and you want to have similar risk characteristics, one of the things you could do is look to protect those recent gains with a put spread collar. And essentially what that does is it gives you a risk reward profile that is rather like that call spread risk reversal we often talk about. So specifically what I was looking at was the September 350, 390, 430 put spread collar. So in this trade, you'd be purchasing the September 390 puts, selling the September 350 puts against it, and then also selling the September 430 calls. And that could be put on for very close to even as of today's prices. So if you happen to hold those shares, essentially you're going to get protection from 390 down to 350. So that's more than 10% buffer to the downside. $40 worth of protection from the 390 strike that you own, which is just below the stock's closing price of around 396. And then you still get the upside up to that 430 strike call that you sold. One of the things you're trying to take advantage of when you use a trade like this is the fact that options premiums, in some cases, and they are here, are relatively elevated. Now, what if you don't hold Domino's Pizza at all and you want to just take the bearish point of view? Then you would just simply purchase that put spread. So Carter, my question for you here is, what do you think about my selection of the 350 strike put? Because when you were showing your charts, and we might want to bring those back up, it looked like that was kind of the level from whence it came.
Well, that's exactly right. That's sort of the midpoint. So there are things to say about a ricochet. The fact that it's occurred is bullish, right? It bottomed in May when the stock market made new lows in June. So you could say, well, the relative strength is quite good. All true. But there's been no volume to it, and it's come a long way. It's almost a 30% move. So that 350 level that you're targeting, I think, is a very sort of astute level to have one's eye on.
Okay, well, I think that's all we've got time for today. I'm sorry that the show on Friday got disrupted. We hope that this Web Extra is helpful for you. And of course, please, if you have any questions, send them to us in the comments, and we'll try to address them later this week. Thanks for watching.